Today's promise. By the end of this video, you'll have a clear grip on the 5 core principles behind volume price analysis, and that's gonna allow you to understand the real power that VPA holds for you as a trader. If this is your first time here, welcome aboard. I'm Caro Trading, and I'm documenting my journey as a volume price analysis trader to make your learning faster. Everything I share is based on the teachings of volume experts such as Coulling and Richard Wyckoff. And these videos are for those who value simplicity and repetition to get better at anything. And as always, don't believe anything I say. Verify it, because only your own experience can show you what's true. Let's. In the previous chapter, we looked at how all the markets are manipulated by the big dogs one way or another. We looked at how the big dogs try to trigger greed to generate fear of missing out buying among the peasants. And we also saw how the same big dogs try to generate fear to trigger panic selling among the peasants. We also looked at how the cycle repeats itself and how the cycle has actually been repeating itself for centuries. In this video, we're going to look at the remaining 4 premises of VPA that are going to give us a solid foundation to master this method. Let's continue where we left off. We left off at point number 2, which states that the big dogs buy and sell not in small quantities, but they do so in massive quantities. Now, what do we mean by that? We know that the big dogs manage a lot of money, but when we say a lot of money, we're not talking about a couple hundreds or thousands of dollars. We're actually talking millions, if not billions of dollars, which then results in the following: that whenever big dogs buy, they have the capacity to buy thousands, if not millions worth of shares. And as a consequence of this, they then also have the ability to create a significant imbalance between supply and demand. Imagine that there is a big dog buying billions worth of a share, then of course the imbalance in supply and demand is going to be where demand exceeds supply. And as a consequence of this, there is an increase in the stock price, which means that the reverse is also true. Whenever they sell, they can sell million worths of stock. And a consequence of selling such large quantities is once again an imbalance between supply and demand. But in this case, there is an imbalance where supply is larger than demand because the big dogs would be selling. And a consequence of this specific imbalance is a decrease in price. Notice how the big dogs, because they manage so much money, they can buy and sell millions worth of stock. And as a consequence, they can significantly affect the imbalance between supply and demand. And the end result of that is that the price of the stock changes. Do we now see how through this sequence of events, the big dogs can actually affect the price that you see on the chart? And that's the massive power that they have. Now, I asked myself this question because I didn't understand why the big dogs would buy in such massive quantities. Like, why can they buy and sell in tiny quantities? Now, in order to answer the question, I invite you to think like a big dog. We have to see it from their perspective to understand as to why do they make certain decisions. We know that big dogs like efficiency with their time and their money. Basically, anybody wants to be efficient with their time and with their money. In other words, we all want to make the most amount of money in as little time as possible. That's basically the definition of efficiency. So there is an input-output equation in which we want to minimize the inputs to receive the maximum outputs possible. That's the equation that we're always looking to optimize, the big dogs as well. Which means that if the big dogs are always engaging in tiny trades, that means they're often engaging in tiny wins, which would equal a tiny profit, and that is just not worth the effort of the big dogs. Think about it. A profit of 10K might be a lot for a beginner trader, for example, but for a big dog, that's nothing. That's just a couple cents for a big dog. It would be like us making a profit of $10. That's quite insignificant for us because we have way more than that in our account. But for example, for an 80-year-old that has a maximum of $20 in his piggy bank, a profit of $10 is actually a lot. It's a significant part of the money that the kid manages. Which means that what is actually worth it for the big dog is to engage in big trades, because that's going to give the big dogs big enough wins, and that's going to lead to big enough profits. And to show you that whenever we're talking about these big dogs, we are indeed talking big sums of money, let's look at some real life examples. This is Nancy Pelosi. She's the former Speaker for the House. In simple words, she's one of the politicians. And the interesting thing is that she is known not only for her massive trades, but also for her suspiciously perfectly timed buys and sells. And what I mean by that is she is famously known for buying stock of specific companies right before the share price went up. And she's also famously known for sharing stock of specific companies right before the price collapsed. So basically, she had a better timing than Warren Buffett. And like any other big dog, she's also buying and selling millions, if not billions, of the money that she has. And that's why this is one of the big dogs known for high volume activity trading. And what do we mean by high volume? Former House Speaker Nancy Pelosi has executed a series of significant significant technology stock trades valued at over 30 million. Guys, we're talking about $30 million. That's a lot for us. Maybe for a big dog, it's not a lot, but for us, it's a lot. And that's exactly what makes an insider an insider. That's what makes a big dog, the amount of money that they can handle. And here's actually an interesting fact. There's this organization called the SEC. The SEC stands for Securities and Exchange Commission. In simple terms, it's an organization that is meant to keep trading fair. So it's supposed to avoid things such as insider trading. And insider trading is when you trade by using information that is secret and not known to the general public, not known to the peasants. And technically that is illegal because that gives the insider that has insider information an unfair advantage. But it turns out that this organization, the SEC, has looked into her case many times, but nothing ever happens. Now, why do you think is that? Well, because it turns out that the big dogs not only control the media that you see, they also influence the organizations that are supposed to watch them. And speaking of the big dogs, another example would be David Perdue. He's the former US Senator and known for insider trading while in office. And he also came under the radar for his suspiciously well-timed massive buys and massive sells. So basically, he was accused of insider trading as well. In Perdue's case, the inquiry looked at Perdue's sale of more than 1 million worth of stock. Guys, 1 million, again, the big sums, we keep seeing them back over and over again. And it wasn't a financial company that he once served as a board member of. And the thing is that based on this information, there are a lot of regular traders like us that have a very special strategy that is still following the big dogs, but not by looking at volume at a chart. I know a couple traders that they trade based on the reports that are published in which the buys and sells of these politicians are stated. So now we understand that whenever the big dogs are moving, they're always moving in massive quantities. Now let's go to the third point. The third point stating that big dogs have a special skill, kind of a magic trick because they can create certain chart illusions. But you're probably wondering, chart illusions, what are you talking about? Let's look at this in more detail. What you're seeing in front of you is a snippet of a chart, and this is something that the price action traders would be looking at. They're looking only at the price candlesticks. The volume would be at the bottom, but a price action trader neglects volume at the bottom. They're only looking at the price action of a specific instrument. This could be anything. This could be crypto. This could be futures. This could be forex. Now, I want you to pay close attention to this candle right here. And let's try to put ourselves in the position of a price action trader. So of a trader that is only looking at this chart. Look at how much the price has gone up over here, and the same thing happened again, and the same thing happened again, which means that if it happened 3 times in the past, most likely it's gonna happen again, because look at how much momentum there is to the upside. For sure there is more momentum left, otherwise how was this huge candle created? So for sure the price is gonna go up. So this is a perfect opportunity to buy, like this is a bargain. So basically the conclusion is, by only looking at the price, wow, there's so much momentum to the upside going on, it's the perfect time to buy, I'm gonna buy. But fortunately or unfortunately, the price ended up falling. And this is what we mean with the chart illusions. By a chart illusion, we mean that it may look like the price is gonna go one direction, but it actually ends up going the opposite direction. And the reason that this happens, and in later chapters we're gonna delve deeper into this to really dissect this, is that through the participation of the big dogs, or the lack of their participation, price action traders can wrongly come to the conclusion that the price is going to go up, while in reality the price is going to fall, and vice versa. Price action traders can falsely come to the conclusion that the price is going to collapse, while the price ends up going up. Now you might ask yourself a very important question, which would be, how can I avoid falling for this illusion? And the answer, surprise, surprise, is volume. And don't worry, we're going to explain later on how exactly volume is going to help us to not fall for these chart illusions. But for now, it's enough to understand that oftentimes looking at the price only, it may look like the price is going to do one thing, but it ends up doing the opposite thing. And that's how as traders, we can get caught on the wrong side of the trade. And that's where volume comes into play. So point number 3, check. Now let's go to point number 4. And that is that the big dogs cannot hide one thing, that one thing being volume, or at least is the thing that they can hide at the least. There are a couple people that rightfully pointed out in the comment section that the big dogs can hide some part of their volume through something called dark pools. But that is something we're going to learn about later on. For simplicity, we're going to state that the big big dogs have one thing that they cannot hide, and that one thing would be volume. Now remember, volume is the total number of shares that are traded at any given time, which means that every single time a share is bought or sold, that would equal to 1 unit of volume. For example, if there are 100,000 shares traded in 5 minutes, then that means that there was a volume of 100,000 for those 5 minutes. So volume is the amount of transactions that happen in a given time. Check. If the big dogs move big, that means that whenever they move, there are thousands of shares being transacted, which means that there's gonna be massive volume. So whenever we see volume, we can say, the big dogs are involved, the big dogs are participating. And this is what we mean when we say that the big dogs cannot hide one thing, which would be volume. It's due to the size of their orders that they become visible on the charts. But here's the thing, the big dogs know we know this. They know that we can see them through massive volume. And that's the reason that the big dogs do something sneaky. What they do is they split their orders to lower their volume per order. Let me give you an example. Instead of selling 100,000 shares at once, they split that one order and they split it into 5 different orders of 20,000 shares each order. So in essence, still selling a total of 100,000 shares. The total is the same. It's just divided into smaller pieces. But what does it mean for us? What does this mean for us when we look at a chart? In this specific chart, we're looking at 2 things. We're looking at the price action and we're looking at volume. From these volume bars, what is the thing that catches your attention the most? And the answer is very obvious. I feel like Dora the Explorer, but it's still nice to ask these questions to make you think. Look at that. Look at these massive volume bars. And we know that whenever we see massive volume, the big dogs are participating. But we also know that the big dogs know we know that. And so what they do is they split their orders. So instead of the big dogs buying and selling everything at once, creating these massive volume bars, how you see here and how you see here, they split up the orders, which looks as follows. This is how the splitting up of the orders look like. Imagine one of these massive volume bars, but then split up into multiple pieces. Notice how each of these bars is still a decent volume bar, that when added together, there is still a massive total amount of shares being transacted. So instead of volume being an explosion, how we saw in the previous slide, it's actually a controlled footprint, but the end total is still massive. So in essence, we're training ourselves to do 2 things: to spot the big dogs by looking at these crazy above average volume bars, but also to spot when the big dogs are splitting up their orders. So we don't spot them that easily, but we can still spot them. And that's what we're going to learn. The bottom line is that volume is the one thing that they can hide the least, be it through massive volume bars or when they split it up, we can still see them, which is amazing. Hence the value of volume price analysis. So point number 4 is covered. We know that the big dogs control the narrative. We also know that the big dogs have access to the information before it's made public. That's the insider trading that we talked about. And we also know that the big dogs buy and sell before the markets move. And we also know that the big dogs move in massive quantities. And the last thing that we'll learn is that big dogs cannot hide one thing, or at least it's the thing that they can hide the least. That thing being volume. All of these together leads us to one undeniable conclusion. To be on the right side of the game, we must spot where the big dogs are participating and when they're staying on the sidelines, so when they're not participating. And how do we do that? By looking at volume. Volume is going to allow us to do the following: to buy when they buy and to sell when they sell. In other words, to be on the right side of the game. And this is how we got to point number 5. Congratulations! You've learned what most traders never figure out. You should be proud of yourself, because the first step is to get the theory, which is what we just did. But getting the reps in and executing, that's where the learning happens. So I invite you to download TradingView. It's free. Look at the first charts. It could be any chart, and then look at the price and then look at the volume bars at the bottom. And the first thing you're gonna notice is look at the above average volume bars. They're gonna immediately call your attention. And now you can actually say to yourself, hey, I see this massive above average volume bar. There are big dogs involved here. They're participating. And later down the road, we're gonna learn to answer the next question, which is, if they're participating, how are they participating? Are they participating by buying, or are they participating by selling? But I'm very proud of us because we're really making a lot of progress. I hope that it's clear that VPA is not a hype. VPA is not new. It's not flashy. It's not a sexy strategy. And it's a method that has survived many generations. For a reason, obviously. And this is why in the next session, I want to look at the legends that use volume in their trading strategies. More specifically, we're going to look at legendary traders who used volume successfully successfully. Because guys, again, this isn't just theory. This is a proven approach that has worked for over a century for many experts. And I'm here to guide you on a path that has clearly worked for others. And the interesting thing about the legendary traders that we're going to look at in the next session is that they have also shared their knowledge of volume in trading. But there were many censorship attempts because it's basically making public how these insiders work. And of course, the insiders don't want you to know that. All in all, I hope that this gives you confidence in what you're learning. That's the most important thing. Last but not least, today's brain tickle. I went through the comment section for my last video and there was a very interesting comment that I loved because it really triggered my thinking. And it's the following. It's from @Russell_Schaufler. I think it's German. And he says, great video. I have a question about the big players manipulating the small players to put in large positions. Are the large players getting the volume to make their trade from the small players? Or is it other large players providing the volume and the small retail traders are just getting caught on the wrong side? Commitment of Traders report shows that large speculators are usually opposite of the commercials, with the small speculators, retail traders, usually not having much effect on the direction. So in essence, Russell is asking two things, and we're gonna simplify them. The first thing is, when the big dogs want to make a big trade, who are they actually trading with? Is it the regular traders like us, or is it other big dogs? And if it's mostly other big dogs, what role do peasants even play in the market? So let's focus on the first part of the question. Whenever the big dogs trade, who are they trading with? Peasants or other big dogs? Let me run you through an example so you get to the answer yourself. Imagine that there is a big dog who wanted to sell 500 million worth of stock. We know for a fact that a peasant, a regular trader, a retail trader doesn't have that amount of money. So it's impossible that a peasant is able to buy 500 million, the thing that the big dog is selling. A regular trader can probably buy only a maximum of, say, 5,000 worth of stock, which then means that if this big dog would only sell to peasants, he would need 100,000 peasants to buy, which is impossible. And how I came to the 100,000 peasants is by doing 500 million divided by 5,000. So how can this big dog sell this 500 million worth of shares if it's not to peasants? The answer is because you have big dogs on the other side. Indeed, big dogs mostly trade with other big dogs because it's mostly the big dogs that can match the order size of big dogs. So big dogs compete against each other as well. It's a game of deception, especially between these big players. And now the second part of the question. If big dogs mostly trade with the other big dogs, then what role do peasants play in the market? Let's look at an example, once again for you to arrive at the answer yourself. Let's say that there is a big dog who wanted to sell his shares because price has been going up. And we also know that most of that is being sold to another big dog that is buying on the other side of the trade. Because as we saw in the previous slide, only other big dogs can match the order size of big dogs. Check. Turns out that since the price has been going up, peasants are also buying out of fear of missing out. So you have two things that is driving the price up at this very moment. Big dogs that are buying and peasants that are FOMO buying. So in essence, what is happening is that this big dog over here is selling. And as a consequence, the price goes down. But the other big dogs are buying. And therefore, the price reduction gets undone. And the peasants seeing this price reduction undone, they're then gonna think that the worst is over. So they're gonna buy out of fear of missing out, making the price increase even more. So in this specific situation, this big dog can continue selling for a little bit longer without the price dropping dramatically and without causing any panic. So Russell, the retail traders are not used for their size. That's what the big dogs are for. In this case, the retail traders, or the peasants, help the big dog sell for a little bit longer without scaring the market. So the role of the retail traders is to keep the price stable for longer. So the big dogs that are on the right side of the game can squeeze the most profit from it. So Russell, to answer your very good question, the big dogs mostly trade with the other big dogs. And the role of the peasants is to keep the price stable for a little bit longer so that the big dog that is on the right side of the game can maximize its profits. So why did we decide to simplify it to big dogs versus peasants if it's big dogs versus big dogs? Because yeah, the game is built to trick everyone, but it works the easiest focused on peasants. And it's easier to explain the market dynamic when we use big dogs versus peasants compared to big dogs versus big dogs, because the latter, dogs versus dogs, can generate some confusion in novice traders. And we're here not to create confusion, we're here to generate clarity. Later down the road, we're going to look at the nuances and we're going to look at the details. But for now, it's important to learn the general laws that are governing this trading strategy. All in all, I hope I was able to provide value to you through this lesson. And remember, enjoy the process. Unless you have other plans.